We'll be now moving on to our panel discussion regarding the future of the hedge fund industry. The panel will be moderated by Professor Nicole Boyson. Professor Boyson is the Associate Professor of Finance at Northeastern University. Her primary research interest is in the area of investments with an emphasis on understanding the risk and return characteristics of hedge funds. Her teaching interests include investments, fixed income securities, financial institutions, and portfolio management. Prior to joining Northeastern, Professor Boyson was an assistant professor in the finance department at Purdue University. She also spent 8 years in the industry working in public accounting, banking, and investment advising. She also likes to bake as well. She has been a CPA for 18 years. She holds her PhD in finance from Ohio State University, her MBA from Case Western Reserve University, and her bachelor's in accounting from Kent State University. Professor Boyson.
Hi, it's my great pleasure to host this panel discussion. You already know quite a bit about the speakers, and I think that we've got a really diverse viewpoint, and we only have 3 microphones, so if I don't like what someone's saying, I just won't give them a microphone. So the way I kind of want to run this, we're in good shape. We have about 50 minutes. I have 4 sort of open-ended questions that I'm going to ask the panelists and ask them to respond in sort of a minute or 2, and then feel free to jump in and talk to each other. I would also ask the audience, if you have some specific questions related to kind of the topic that we have, feel free to jump in, but know that we'll have 15 or 20 minutes at the end that you can ask sort of any questions that you like. So here's your chance to ask questions that haven't yet been discussed. Kevin stole some of my thunder, so I'll save that question for later. But anyway, so let's start. I want to talk first about the composition of the investors in hedge funds. And so I do research in the area, and from what I understand, it used to be sort of lots of rich guys, and then institutions decided to jump in, like pensions and endowments and other institutional investors. And so I wanted to ask each of you, with your own kind of viewpoints, first of all, sort of how has the composition changed over time? And second, what challenges does this present for hedge fund managers going forward? So why don't we start with Paul?
Well, as I said before, I think the history of the industry began with individuals. That's moved more and more toward institutional investors. And I think that overall for the industry, the institutional investors come with probably more demands, expecting higher levels of not only performance, but transparency and reporting and accountability. So I think those are all good things for the industry. I think in terms of, from a hedge fund manager's perspective, though, the hedge fund's a business. And like any other business, how well you do depends on who your customers are and where you find customers. So it's good to have a diverse customer base. A lot of hedge funds will try to keep their funds open not only to appeal to large investors. Having $1 million minimum is not a slight against business school students by any means, but it's part of managing a business where, again, the number of the original exemptions required a certain number of limited partners, and therefore taking small contributions from retail investors wouldn't even make sense, even if it were permitted. So there's a threshold to keep things manageable. Hedge funds usually don't have anything like the customer-facing abilities of a mutual fund. There are a very small number of investors. A lot of time, a lot of the investment process, one thing that didn't come through is investors will spend months, sometimes a year investigating, doing their due diligence process on a fund before they'll make an investment. So there's a lot of investment in by the managers in investor relations and contact with them, and that has to pay off. So I think from the manager's point of view, it's good to be diverse. A lot of funds will try to have some institutional investors, some individual investors, and they're concerned about keeping money. So lockups force money to stay there for a while. It doesn't give people a choice. But over time, for the funds that make it into those longer time periods, the more stable funds, not the ones that end up in the dead fund graveyard, it's important to have the right kinds of investors to have some business stability, and different kinds of investors may have hot money and may move in or out. So I think there's a role for all these different things. It's a very rich and diverse and heterogeneous group. It's certainly moving toward larger investors, but I don't think that the pension funds and endowments and other institutional investors have by any means pushed out all the investors who are originally driving the space.
Thanks. And whichever of you'd like to go first.
I guess I'll go next. So the industry is probably shifting more toward Europe and Asia, actually, more Asia, in fact, and of course it is becoming more institutionalized. One of the problems with hedge funds generally is they're not necessarily tax efficient, most of them, and in fact they're harder to be tax efficient nowadays because of the tightening up of the rules in different ways. And so the rich individuals are perhaps a little getting less interested in hedge funds because taxes are really, they should be a big part of their what they'd be concerned about. Whereas most hedge funds are offshore and they're invested from foreigners in various ways. They may be dodging taxes, I don't know, but a lot of them are just taxed in totally different ways. And so definitely becoming more institutionalized.
Yeah, so since I'm going last, so I'll not repeat the points that were made before, but I think, it has both costs and benefits. So like Paul said, in terms of transparency and disclosure, that's probably going to increase with a lot of institutional investors getting into the space. And I think the other issue is about liquidity. So clearly, hedge funds provide limited liquidity because we didn't really have a lot of discussion of that this morning, but they have lockups and they have these different redemption periods when you can withdraw your money. So I was in Paris last week talking to one of a large French bank, Lixor, and they run a managed account platform which is basically provided to institutional investors so that they can withdraw money from hedge funds anytime they want. And they also get to see the trades of the fund manager. So they clearly are demanding a lot more disclosure, but it's not clear that this disclosure is free, because what it does is that when you actually allow one group of investors to withdraw money, then it can create negative externalities for other investors in the same fund. Because clearly not every fund may be willing to be a part of a managed account platform, for example. So there is this issue of heterogeneity amongst investors, which can create some kind of wealth transfer between the different types of investors. So I think there are some other issues that can arise when there is more disclosure and transparency. The other thing is that a lot of the institutional investors might want to get simply into a clone, which was talked a little bit about before. So if you can replicate hedge fund strategies, then you can buy the beta product and then you can overlay it with the alpha. So then you can really customize it to your requirement. And this might be something that the industry might sort of progress towards with more sophisticated investors getting into it. So.
Yeah, and from the perspective of you who's running a fund now and you who were running a fund until very recently, were you trying to go after the institutional clients, or was it more they were coming to you?
I think, we had sometimes interest from institutional investors that we really weren't even able to meet. So a lot of institutions were looking for scale. We were a small hedge fund, and I think one thing, in looking at averages of hedge funds, it does leave out what happens for some of the individuals. And it tells us what happens for an industry overall. It doesn't tell us how individual investors in hedge funds do, or investors who have a portfolio of hedge funds. But in the life cycle of hedge funds, they often, as was implicit in the other two talks, I think you can see, there is a cycle where to even get off the ground, funds that are successful do attract money after they start getting a good track record. Investors do, as Vika said, look in the rearview mirror. But then as the size gets larger, sometimes those opportunities either go away or they get diluted, or they're not the same. So at one point many years ago, I remember when we were looking, we did turn away money because saying this might seem counterintuitive, but we were looking for $50 million, and we had institutional investors that said, that's nice, but we don't want to give you less than $250 million. And we said, well, we don't know what to do with that. We could buy treasuries for 200 of it and charge you, an incentive fee, but that doesn't make sense for anybody. But the bigger problem with that was that their expectations were really unrealistic. You know, we were a better match for smaller investors. The larger ones are not. They were looking for a lot of capacity. They're looking for a very steady state investment machine, and they shouldn't have believed that anything that we were doing at the $50 million level was necessarily going to translate to 250. And that was our ambition. Our ambition was to get much larger, but they didn't have a good rational basis or a track record to go on for doing that. So there's a better match between the larger pools of money and the larger funds, and those are just the nature of averages, and large numbers and large pools are going to be more in line with what we saw for the overall trends. But it really is going to depend on the match for the different investors in the funds.
Well, even rich people don't typically want to invest more than $1, $2, $5, say $5 million in a single hedge fund. So unless you're Bill Gates or somebody like that, but generally it's hard to put together a large part of your investment pool from wealthy individuals. We're happy to take that kind of money, but it doesn't add up to a very big portion of the money that we manage under management. On the other hand, yeah, we certainly, as Paul pointed out, a lot of the institutional managers think we're too small. They talk to us when you get to over $1 billion because we want to give you $100 million, and so yes, most of our money does come from institutional managers, but you really need more scale than we have in our firm. It may seem like a lot of money, $500 million, but it's not a big enough scale to actually take on these institutional investors.
That's interesting. And so, I mean, do you think you can take it as far as to say because of the influx of institutions into the business that maybe is part of what's driving the returns down? It's just too much money chasing too few opportunities?
Yeah, actually, and the money is going to the bigger funds for the most part. And so they're definitely too much money, and they're going to the bigger funds because they can't give the big pieces to the smaller funds. But basically, the bigger funds are less and less able to actually extract alpha out of those huge investments that they're making. And you do read about it in the news all the time about what happens with, like Paulson did so great during the financial crisis, but subsequently has had really pretty terrible returns. And one of the great successes is SAC, but you kind of wonder, if you read the news, how they've made those high returns now with something like 6 of their people being pleading guilty or indicted or something like that. I'm sure you have some relative in the room here, but so I can't say too much about that. I don't have any firsthand knowledge, but it's harder and harder for these big funds to basically produce these returns.
And so that kind of leads into my second question. I want to talk about performance because I think that's, of course, why people buy hedge funds in the first place, and risk-adjusted performance sort of being what it is. Your graphs were great, Roger. I had some questions about performance, and I'm really interested in kind of what happened in 2011 and 2012. So alpha went negative in 2011, and it wasn't a great year for the stock market. It was kind of flat, but alpha was pretty big and negative. And then 2012, we got nothing. And so, I mean, you don't want to be too dramatic, but is this an industry that is no longer going to have outsized returns? On average, certainly that's an interesting question, but do you think there are still some small players in the business who can really outperform? And we'll start with Roger, since you've already talked about it. And then I definitely want to hear from Vikas and Paul as well.
Yeah, actually, I think that the alphas are still there. Actually, if you start to 2013, I didn't have anything from 2013, but first quarter was a super year for hedge funds in general. So I don't think the game is over, but we're definitely you're not going to get the alphas that we got in the past, that's all. They'll be positive, though, I still think.
And maybe, Paul, you can talk about kind of why, and the size being kind of the obvious elephant. I'm sorry, the size of the funds in the industry is the obvious sort of elephant in the room, but there might be some other reasons too that maybe we should kind of talk about, and obviously looking for any comments or thoughts you have as well.
Well, I think, I mean, the alpha in aggregate has to do a lot with what opportunity there is in the market and how well people manage to extract it if they can. In the kinds of investments and trades and opportunities, market inefficiencies that we were looking for, a lot of times people would say, well, why are these things there? And I'd say, well, I don't know, but I do know what to do when I find them. And sometimes it's like fishing. You go out and you put your net and you can do the same thing. And if there are no fish there, you're not going to come up with anything. And sometimes you may have the same equipment and there are a lot of fish there. We did very well in 2007 and 2008. We were doing the same thing we had done. It was just many of the same opportunities got much richer. The markets were much less efficient where we were. And it wasn't something that we had any control over or had any prediction about. We had a way of saying, if we see something there, then we'll capture it. And the day when, the nets keep coming in empty, well, now the markets are efficient. That's what we know, ought to be a good outcome. And then we'll either go home and do something else. But it's possible that these opportunities move from one area to another, that they're driven by other kinds of factors. So I don't have any view about that either market-wide or in the narrow space of running a small hedge fund. But it's certainly interesting how it shows up overall in the industry.
So I have 2 points about it. One is how alpha actually relates to two things about in the hedge fund industry. One is there are just, when you become bigger, there are just decreasing returns to scale because you cannot generate the same alpha on larger assets under management. So you are a $100 million fund and you become a $10 billion fund. To generate the same alpha is extremely difficult. So that's the first issue. The second is there are capacity constraints in certain sectors. So if I am a merger arbitrager, this is kind of the fish example that Paul gave. So if there are no mergers in the market, then there is no way I can invest $5 billion in the merger arbitrage strategy. So that's the other issue. That's the other thing that affects the alpha, that you cannot scale your strategy to any number because it depends on the particular strategy that you're using. Some, I think in the long short equity space, I would think that you have a little bit more scope for scaling it, but some of the other more specialized strategies, it's difficult. So that's one issue. The second issue is that I'm not sure about the measurement of alpha. So I mean, that's where it becomes very tricky with hedge funds because their exposures are not like mutual funds. And when I started doing research in this area, one of the first things I was looking at was this sort of non-linear relation between the market and the hedge fund returns. So it's not, alpha and beta are two sides of the same coin, because when I measure the beta, I measure alpha at the same time. So in case of mutual funds, it's very clear because the betas are easily measurable. So you can say something about alpha. But in the case of hedge funds, I don't think the academic research really agrees on how to measure these alphas. So that's the other issue. So there is a measurement issue that we still need to address.
I want to comment, at least in regard to my own paper. I showed you really simple measures of alpha, what I presented today, but when we did more complicated measures of alpha, put lots of factors in and so forth, the alphas actually did not decrease at all. Actually, even went slightly up. So I don't think it was so sensitive to the actual measure of alpha, of beta, I'm saying. Of course, it's conceptually very sensitive, but when you actually looked at the data, it didn't seem to be very... all the different types of like the squared returns or VIX or all different types of things you put in there, they didn't really affect the alpha.
That's interesting. So when I asked this question, the same question to a hedge fund manager friend of mine, he said, can't we just blame the ETFs? And I thought that was kind of funny. So he thought, well, ETFs are causing hedge fund returns to go down because everyone's trying to do what hedge funds are doing, and we've got all these sort of index products. But what do you think the impact of the Fed's low interest rate policy has been on hedge funds over the last couple of years? Do you have a thought on that?
No?
Oh, well, okay.
I can just
Good, because I was stumped on that one too.
Well, I think the one most obvious one that I can think of is that when you are in a low interest rate environment, then it basically makes leverage cheaper. I mean, that we saw in the housing market. I mean, why we had a big bubble in the housing market? Because people were able to borrow very cheaply. And so that means that, even if you were not earning a whole lot of money, you could basically buy a house many times over your annual income. And so the same thing can happen in the hedge fund environment, where if leverage is cheap, then you can see an increase in the leverage. So you will see that there is actually some correlation between but now leverage is very hard to measure, because I'm talking about on-balance sheet leverage, and you can have off-balance sheet leverage through the derivatives positions. So that becomes a little bit harder to measure, but at least on balance sheet leverage, you may see some effect there.
I'd like to comment on that, though. Although leverage is cheaper, definitely cheaper and easier to have more leverage, the hedge funds were chastised by the financial crisis of 2008, and because leverage, they got hurt so badly. You saw they had the negative returns, even though they had the positive alpha, they had those negative returns. The leverage so badly hurt them that basically subsequent to that and subsequent to the collapse of certain hedge funds, we find that leverage has really dropped despite the fact that it's not so expensive.
Right, and so that was one of my thoughts. Is it a fear story? Our hedge funds, they did fine during the crisis. They did quite well relative to the markets. But after that, the market rebounded, and it seemed that hedge funds didn't ride that train. And so it's interesting. I mean, sort of, if you have some thoughts on that, maybe Paul? No, nothing. I'm not trying to put you on the spot. No, that's fine. I mean, so my thought is that a couple things. So the Fed keeps rates low, which means the stock market's going to do well, right? It's much harder to do better than the stock market when the stock market's doing well. This is kind of my thought process. You're seeing betas increasing, Roger. I think that was in your slide, sort of correlations increasing. I don't know if you showed betas increasing, but definitely correlations increasing. So it just strikes me as perhaps it's just, it's hard to beat the market when the market's doing great. And if the Fed is artificially keeping rates down, which is probably artificially keeping the market up, maybe that explains the story. So,
well, I was just going to say, one reason I took a pass on your last two questions is that, a lot of times for investment managers and investment professionals, everything moves along with what the financing rates are, as long as they're stable and predictable. So, the sea level rising is not a problem if you're out at sea in a boat. It's a problem if you're on land and you've got beachfront property. But, the financing, all of the leverage or other decisions we would make are all relative to what financing rates are, and we sort of adapt dynamically to what the situation is. I think the bigger picture, though, is, as you said, the intent of lowering the rates is to encourage capital to take more risks and be pushed into more productive uses, to be put into the capital markets, and then that flows through in the secondary markets for the kind of things we see as investment opportunities. But in the first instance, the kind of leverage decisions that we would make would really be based on how risky we think our positions are, not so much on the cost of capital. We kind of build that into everything we do anyways. Makes the calculations a little bit easier when you're subtracting 0 from all the numbers instead of another number. But for the most part, it's built in on the capital markets facing side. And the question of where these opportunities come from, what investors are looking for, I think that's where it plays a bigger role.
And so one more question kind of related to risk and returns, and then we'll talk about some other things. But what about volatility? I mean, how does the volatility in the markets, whether it's the stock market, bond market, whatever market you're in, how does that play into your investment decisions when you're trying to figure out what to go long and what to go short and how long you hold it and all those kinds of interesting questions?
Well, volatility is actually when you're hedged, you're often not so sensitive to the volatility. I will say our funds have really low volatility. If you're the volatility of the stock market might be high, but if you have a 0 beta on the stock market, you're not so sensitive to the volatility of the stock market. Or if the volatility of the bond market is high as well. But if you're if you're really extracting alpha, you're not so affected by volatility. Now, frankly, though, most hedge funds have so much beta in them, and we saw how those correlations were rising, that most hedge funds are quite affected by the volatility. We just happen to be not affected by it.
So some of the work I did before basically shows that if you actually look at these entire set of hedge funds, 10,000 odd hedge funds, they tend to have short volatility exposure. So basically, a lot of the guys are showing exposure as if they are riding out of the money put options. So if I sell insurance, then basically I would get a positive return most of the times, but once in a while, then the market goes down, I have to pay big time. So, so that's the sort of risk that we found. And in fact, something more recently that I did was to actually look at implied volatility and actually skewness and kurtosis as well. And you actually, so if you look at VIX, VIX is basically a forward-looking measure of volatility. And so we found a similar kind of effect, which we did for actually 3 different strategies, including long-short equity. So Roger is actually an outlier because for overall long-short equity, we did find significant exposure, which you said for people find in general. So, so we found that there was a short volatility exposure. But if you look at trend followers, like CTAs, that they are basically long volatility. So it depends on the nature of the strategy. So they tend to do very well in volatile markets. So it's not uniform across strategies. That's based on work I have done in this field.
Yeah, by the way, my firm that I'm the chairman of is Zebra Capital Management. The zebra, some people always ask, how did they come up with the name zebra? You could be bad stories about, of course, how tigers and lions chase them and so forth. Not tigers, but lions. I've got the wrong continents. But a zebra for us, the name actually came from zero beta. So zebra is just a play on zero beta.
Just 2 comments on volatility. One of them is it seems to be an empirical property of volatility that it does change levels, not always predictably, but it does persist for periods of time. And markets and investors seem to be pretty slow to react to that. It's actually much easier to predict volatility than it is to predict returns. And since, as you saw a number of times, we often look at return to risk ratios, knowing that the volatility is going up or down means you can predict the denominator even if you're a little unsure about the numerator. And that can make a very big difference for asset allocation decisions. So even if you've got noisy estimates and you don't know where the alpha is and you don't know where the returns are, but you do see across different investment opportunities or different managers that the volatility may be changing, there's a great opportunity to take advantage of that, and yet people keep being surprised. If you, there's an article I used in my class from a couple years ago. We've had the most market swings ever, in the last few years. Markets are more volatile than ever. But in fact, if you say, well, okay, maybe the first shock, maybe the first couple months were a surprise, but now I'm in a volatile period. I expect it's going to be that way for a while. If you sort of renormalize your expectations, if you scale things to the expected level of volatility, it turns out the jumps subsequently were not that big and not that much different from other periods. So having, it's common, I used Roger's standard deviation of returns over long time periods, but it does change over time, and it's important to take that into account in making decisions. Now, in our fund, some of the strategies we ran were trading volatility. So I should explain what that means. I'll just give you one 10-second version of it. Volatility measures the size of random, unpredictable movements in asset prices. So imagine that in looking at securities, say equities, you say stock by stock you go through and someone asks, normally investors ask, is this going up or down? What's the return going to be? And our view was, we have no idea if it's going up or down. We're going to predict how much it's going to move. So up or down, we're absolutely indifferent. We don't know, but we'd like to know, is it going to go up or down, the random movement on average 1% a day or 2% a day? And if the market thinks it's 1% and we think it's 2%, we can bet on that using options, and we can hedge out our exposure to the direction by taking an offsetting position in the underlying. Excuse me. Unlike what I said before about hedging being always free, if there's some curvature or some asymmetry involved, then it costs money. You can be either buying or selling. But we went systematically, and we made sure, much as Roger said in his fund, that we had a zero beta to the stock market, but also to each individual security we had, and to movements in volatility. So if there was a big shock in volatility, we had not only equal long and short equity positions, we had equal long and short option positions. And a lot of people thought that was kind of overkill or unnecessary because 2002, when we started this, volatility was going down and down and down. If anything, there was no more volatility. And all these people who'd been betting long volatility were going out of business. But we said, how about neutral? That sounds okay. When the shocks came and a lot of the volatility funds that made a lot of money were outright long, or that either made a lot of money or went out of business, had directional bets. They were either long vol or short vol. And one of my favorite pictures for what we were doing was our sort of scatter plot showing that our beta was neutral both to the S&P and to volatility overall. So just as Roger was saying, you shouldn't have to pay for beta. It's something that can be hedged out by the investment manager. The same thing is true for volatility. As Vikas mentioned, taking a look at the VIX, it's something that actually can trade. And if you see exposure to it, it's something that can be hedged out as well. So it's part of the markets. If you don't know what it's doing, if you're an investor, or an investment manager, you can neutralize it and cancel it out. If you can predict it, you should take bets on it, either by making volatility trades or by looking at more careful volatility forecasts in asset allocation decisions.
Yeah, just to put this in context, I've been a historian as well as a practitioner here. And we've had these spikes of volatility related to the financial crisis and, say, the tech bubble and so forth, crash. But volatility was really much higher in the 1930s. So long before your time, I guess. Even before my time. In fact, pretty much on my birthday is when volatility dropped dramatically. But basically, up till basically middle of World War II, volatility was much higher, and then it dampened. So if you look at a long-term volatility chart, we now have much lower volatility. However, we do have these spikes when various big events happen.
Thanks. Those were useful comments. So let's talk about the other thing that matters a lot to managers, liquidity. So Roger, I know you have a fund that trades liquidity, and I'm interested in liquidity personally, so maybe it's a selfish question, but sort of from both sides. So in terms of picking stocks, there's liquidity premium, and it would be nice if you could talk to our students about that because I think they'd find that interesting. And then also how you manage liquidity in your fund in terms of flows.
Okay, well, our strategy is essentially to buy fundamentally strong companies that are less liquid and short these are stocks, and to buy and to short the more fundamentally weak companies that are most liquid. Essentially, you're betting against popularity. The ones that are really active there have the worst returns. If there's a lot of interest in a company, it turns out it's too much interest. And on the other hand, the companies that are sort of overlooked, that's where the real opportunities are. In fact, the very worst kind of returns are like small microcap stocks that have high trading volume. There's too much interest in them. And so it isn't all liquidity. It's partly more generally popularity. But basically, you have to go against the grain in order to get the better returns. You have to buy what's less popular. It's understandable that there's a liquidity premium, though, in the stocks and bond markets. I mean, if you ask somebody, what would you like in your portfolio, you want your portfolio to be low risk and high liquidity, right? But that, in fact, neither one of those things are free. If you want to get returns in your portfolio, you have to take on some risk and give up some liquidity. That's the way you get returns. Basically, you get returns by buying the kinds of stocks that other people don't want. And if you want to you should short the stocks that other people want too much. That's the sort of the kernel secret of how to really make money. Now, I can tell you that, but you're not going to do it because you're all going to be prone to go after. You all going to say, "I want the more liquid stock. I want the stock that everybody's talking about. I don't want the stock that nobody's interested in." But you have to actually go against your own nature if you really want to succeed in investing.
If you want to talk about the liquidity aspect of stocks, that's fine. Or if you want to talk about how you manage liquidity sort of during the crisis, if you had investors that were clamoring at the door, and even more broadly about how other funds might manage it.
It's a lot of questions. Okay.
Sorry.
So let me just talk about a different market because it complements the picture that Roger said. Absolutely, there are premiums to be earned for liquidity, and there's some people on the finance academic side who would say, so what you have really is an alpha. It's really a liquidity premium that you're earning. And there's no absolute definition of alpha. So that game goes on every time you think you've satisfied the critics. There's some new unpriced risk factor that has to be behind what you're doing. But it's even more interesting in a way in the derivatives markets. For those of you who've studied, say, options, you know that options, in theory, can be replicated by dynamic trading of stocks. So why do we even have both instruments? Well, in a perfect and frictionless market, we'd have redundant instruments. In practice, it's very interesting. The equity derivatives markets are huge. There are maybe 300,000 instruments that trade in the US, and the liquidity in individual contracts for a particular strike in term is actually pretty thin, but in aggregate it's large. So there are opportunities to be made by providing demand for people who want a particular strike in maturity and trading that off, taking an offsetting position in different contracts or in dynamic trading in the stock. So a lot of what goes on in whether it's market making or trying to arbitrage opportunities in options or in other derivatives comes about from intermediating liquidity demands and earning a premium for that. So I'd agree with Roger. It's a big part of finding investment opportunities. Many things can be explained by liquidity differences for investor demand. Now, learning how to do it is really hard because we have lots of models for asset pricing. We have lots of models, both theory and practice, for portfolio construction and for trading. But predicting liquidity and what it will cost to trade something is really hard. And in fact, it's very hard to even say there's a science of it. There are some working models, and it's also one of the things that manifestly does not scale. So if you're good at it in a small scale, and then people like it, and you're reinvesting money, and you have new investors coming in, and they say, "Great, we love your strategy. We'd like to do it twice as big or 5 times as big." It's just not true that if you're looking for specifically those liquidity opportunities, that you can do it at a larger scale. In fact, that's what liquidity means. It means it's hard to do the trade. There's a difference. The supply curve and demand curve start looking different the farther out you go. And the whole complexion of the strategy changes as the scale changes with liquidity. I'll make one comment about what happened during the crisis. We had mostly our investors were locked up, so we didn't need to worry too much about that. But we did. In fact, we were doing well during that period, but we were hanging on tight. One thing that was interesting and very surprising was when there was a ban on short sales. So there was a concern to help stabilize the markets that maybe we should suspend maybe short sellers were out destabilizing everything, and there was a short sale ban on financials. Now, as I said, we were neutral to everything. We didn't have any directional view, but we had lots of short positions. They were hedges against other options, but it didn't matter. It was a big problem for us because we couldn't hedge our positions. We weren't betting against anything, but one side of our trade was restricted by regulation and law, and the other side wasn't, and we couldn't match those. So what we did is we sort of took our foot off the gas pedal and coasted for a while, waiting to see what would happen. We stopped adding new positions. We tried to do other things to manage the positions that we had. But we didn't know. It could have been that way forever. What we saw in the markets was interesting because we looked at this afterwards. What we found is that in even among some of the most actively traded equity derivatives options on some large financial firms, some other firms who were in play, the volumes dropped a lot, but the spreads, the spreads got wider. The spreads got up to, 5 to 10 times wider, the bid-offer spreads, but the volume dropped by maybe a factor of 2. So if you had, dry powder, if you had capital and you were committed to going through while everyone else was taking their foot off the gas, there were a lot of opportunities there. But it was a very different thing that people were not necessarily prepared for or equipped to handle and go through it.
Okay, and so then for the last question, which hopefully will encourage you to ask some questions as well, I want to ask both of you, and because I'm not leaving you out, you might have some thoughts on this as well, because I know you've done some consulting work, but these are students who might want to work in hedge funds in the future. And so, I guess advice, tips, strategies, get an MBA, not get an MBA. So just based on both of your experience having had some young people come through, and what your thoughts are in terms of giving advice to students. So start with Roger.
Well, I'll start off with it's not an easy industry to get into. In fact, the whole investment management industry is not such an easy industry to get into. Often you don't start out in that industry. You go somewhere else and do something else, and then you come into the industry. So, but certainly things to help you would be MBAs or even PhDs, things like that. In our shop, we need PhDs actually quite a bit. So they're not. I can't offer most of you jobs, or I'm sorry for that. But basically, we really need very specialized expertise, and so but of course, there's all kinds of hedge funds, and there are potential, at least you're in the right location, Boston, Connecticut, New York, London, Zurich, Geneva. If you're in one of those locations, you're at least where a lot of the hedge fund industry is. But it is, I don't know how to really give you advice, because it's a little hard to crack into the industry.
I certainly agree with that. I've talked to a lot of people, as Roger mentioned, a lot of people come from other fields. So a lot of times I've given advice to people who are getting PhDs in other fields who are interested in finance. At MIT, they used to run a panel discussion I went to a few times for graduate students in other fields. There'd be nuclear engineers and chemists and other people. And I'd look at a room like this, and my first thought was, does your advisor know that you're here? You might not, he thinks he's training you to be a chemist, and you're going to go over to the dark side. But you're all business students, right? But you want to be here. But the same advice applies, which is that get your hands dirty on data and looking at real investment problems that people are working on. Have some familiarity with the kind of issues. The exact match is going to depend on the firms, and especially hedge funds can be very idiosyncratic. It's really hard to say. And across the industry, hiring is not always that rational. For a business that's supposed to be involved in managing risk, portfolio managers at investment firms are sometimes very risk-averse in their hiring. I remember when we were getting started, I had some help from an unexpected place in recruiting people. I talked to a friend of mine who is at one of the big investment banks, and he gave me the names of some people he'd interviewed, and nobody ever does that. And he said, well, we're not hiring anyone again, ever. And it was one of these cycles, they'd gone through, and it's either feast or famine. And other times they grab people who have barely any qualification or just have a degree. So don't be discouraged by the timing. These things are cyclical, and you want to take a longer view than that. That said, the things that get people's attention are having an ear and a hand for some of the day-to-day problems they're working on. And I'd say that especially in the smaller kind of hedge funds, the kind of thing that not me personally, but I've seen among other colleagues and people that managers often really keep an eye out for is potential future strategies. I think that most managers, if not, and certainly the best managers, are somewhat paranoid. Everyone thinks they're living on borrowed time. Ideas do get copied. No matter how secret you are, other people figure things out. Trades get crowded. People get into things. And managers and businesses look for innovation. They look for new ideas. And if you walk in and say, look, what you're doing is all wrong, and I've got this great trading strategy. I've been doing it with my roommates. You might not get a great audience, but if you show that, but still, that actually counts for a lot. You'd be surprised. But you do want to think about showing a possibility of offering a source, not just of implementing and executing other people's ideas or doing background research, but of bringing new alpha ideas to the table yourself. People view new hires as buying cheap options. So they're looking for the potential upside. They know that you may be at the money right now, but they're looking for what you might bring in the future. So those are the kinds of things. And obviously, I wish you all good luck, and not to be discouraged by anything that seems difficult. It always seems like a difficult market at the individual level.
Unfortunately, they don't come recruiting. You won't, like investment bankers will come recruiting, but investment managers, even in general, rarely come recruiting.
I'll open it up to questions from you. Now is really a good chance to ask some questions to our panelists. Kevin?
So I just have a question regarding... So I just have a question regarding this paradox that seems to be going on. It seems to be aware that it's hard to scale strategies, that alpha decreases as fund assets tend to grow bigger. So why do institutional investors still demand that you have to be of a certain size? Wouldn't it be better, not from an operation standpoint, managing all these different types of positions, but still from an alpha generating standpoint or a return standpoint, wouldn't it be better to invest in multiple different strategies and multiple smaller funds?
So my view is that in the industry, there are two types of funds. One are asset gatherers, and the other ones are alpha generators. So basically...
That's a nice way to put it.
Yeah. So basically, what institutional investors are looking for, I kind of made a comment while I was presenting the first paper, that these institutional investors are looking, they have career concerns. They don't want to go to a guy who had just started in his house trading and managing a small amount of money, because the problem is that if they invest a big amount in this fund, they would be the largest investor in that fund. And so they're trying to save themselves. And simply, they're not really thinking purely about alpha. So their objective function is not really to maximize the alpha, but there are other things which go into their objective function. And that's the reason why you see that institutions prefer to go with very large funds, which might simply be, Roger is running a great fund, but he doesn't, he doesn't want to grow it beyond a certain point. I'm sure he wants to, but there are certain, he's prudent. He is trying to make sure that he can continue delivering that, and some of the institutions would not get into the fund because of, they are worried that if they end up with a fund which blows up, then their whole own job is at stake. So that's my one.
I accept that.
Oh, that's quick.
Well, I'd say there also are people who see that as an opportunity. So there are some institutions and also individuals and hedge fund consultants who go after the funds that the institutions won't invest in. And they make careful studies of the life cycle of hedge funds, and they try to look very closely individually. But it's a very expensive process. But they do try to pick the best ones. And it's kind of like picking the best stocks. You can take the view that, well, picking the best stocks is futile. We're really picking a bunch of factors that are overall. We might as well, have some passive strategy or invest in some sector type fund. And that's like just taking a hedge fund index or a hedge fund average. But there definitely is a large segment of the investor population that really believes in the individual stories and the individual funds. And they look for I mean, there's the opportunity. There are the ones that are not bid out of range. But it's also very dangerous. You know, a fund with a 1-year track record or a no track record at all, a lot of institutions will say 3 years minimum, and you can see that avoids a lot of the dead companies and stories. But some of the other, there are other investors who say, no, those are all the great opportunities. And in fact, by the time, even if they don't have backfill bias or any other bias, still by the time they've got a 3-year track record and they make it there, their best days may be behind them, whatever the point is. So there certainly is an opportunity for some investors to find things that are not all snapped up or locked up by the big institutions, and for anyone with a very entrepreneurial bent who wants to go out and start a hedge fund, and you're asking yourself, which investors should I look at first? It's investors who would be receptive to that kind of story. So, it's interesting that those things are there, and the market will sort itself out that way.
Sure. He's going to bring a microphone back to you unless you're extra loud.
I'm really curious about the 220 cost model that hedge funds run on. So, for example, in 1993, a decade ago, you see ETFs going into the market, and a lot of money flow from, say, institutions all the way to, retail investors flowing to these ETFs. And then more recently, there's the new financial product called a motif investing. I'm not sure if you guys have heard of it, but it started by someone called Hardeep Walia in 2010. And basically, you charge $9 for every transaction. No gate, no lock-in. In a nutshell, that's how it works. So how would these alternative financial products impact money managers and their career?
Talk about fees, right?
Yeah. Okay, it comes to me all the time. All right, let me take a dig. So I think there is clearly a lot of pressure on the hedge fund industry in terms of the fees. So I talked a little bit about that in my fee change paper, which is, so I think competition is coming from inside as well as outside. So I talked a little bit about the fact that you cannot be charging completely out of, not in sync with other funds in the same strategy. Okay. The other thing is that you also have competition from outside. So clearly when the equity market is doing remarkably well, nobody is going to give you 2 and 20 to just deliver return which looks very similar to S&P 500 or whatever equity index you're looking at. The other thing is with Nikki, I did a paper a long time back, so let me talk about that. So in the mutual fund, there is also this growth of hedge fund light products, which is that mutual funds are coming in and saying, we can offer you the same product as a hedge fund, okay, within the mutual fund space. So it will be regulated and it would be cheaper. We will not charge you this 20% performance fee because as a mutual fund, you cannot do that. Okay, so one of the benefits of not being regulated and not being a 1940 Act fund is that you can charge asymmetric fee. You cannot do that as a mutual fund. So now investors have other ways of getting exposure to hedge funds. So you're getting competition from some of these mutual fund products. In fact, you have even clones which are basically replicating the beta exposure, and you can get it for, I think Paul talked about it, or I think 1%. Okay, 70 bips, 80 bips, you can get that. But clearly, you're not getting the same sauce because the alpha is manager specific. So in the paper that I did with Nikki, we found that the guys who come from hedge fund side, when they offer those products, then those funds do well. But if the mutual fund side, the guys who come from traditional long only side, when they start offering those products, they don't really do well because it's not like one day you wake up in the morning and say, okay, now I should try my hand short selling. I mean, it's not going to work because you need to have some expertise in that area. Okay, so I think the jury is still out on, I make this comment that when you give peanuts, you get monkeys. Okay, so basically the point is you can't, so I think the right question to ask in my view is that what is the alpha per unit of dollar fees that you're paying? So you're getting in the market all kind of products, and you as a smart investor need to really figure out how much is the alpha they are generating on the dollar per dollar fee that I'm paying.
Yeah, one of the basic problems is that people believe in sort of magic here. The invest and and they imagine that if you generated some high alphas in the past, hedge funds that have generated high alphas, that they're going to continue. We've all talked about reversion to the mean. Those high alphas that they produced are not really so achievable in the future, but the fees have held up in the industry surprisingly well, considering that alpha is dropping, and the magic probably is not. You always can find some fund that did really great, so as long as the money goes there, everybody thinks they're getting a good deal. But it's easy to find the funds that have done great. It's much more difficult to find the funds that will do great. And so I think actually the fees are probably too high in the industry, frankly, considering what I think it will deliver in the future.
There's another perspective in terms of thinking of where some of the ideas come from. So, and I do think the market sort of sorts this out, that some of the best ideas are things that don't necessarily have a large scale, and it's hard to stay in business for a very long time if you don't have any alpha. And investors are certainly overconfident. Investment managers are overconfident too. But after a certain number of years, someone is not going to be with smaller assets in a 2 and 20 space where they're not getting, if you have a bunch of years where you don't get your incentive fee, if you have $5 million, okay, you can live off the management fee, but most of the funds are smaller than that, and they're not going to survive. However, there are other models, like the mutual fund business and other institutional managers that are asset gathering, as Vika said. So, suppose you have a new idea and you say, how much money can this make? How much alpha is there in it? And what's its scale? Now, they're almost always inversely correlated. If you say this is something that makes a ton, it only takes $10,000 to run this and have a margin account, and it lays golden eggs every afternoon at 4 o'clock, I bring them in. Why are you going to share that with anybody? You don't need any capital. So there are people, a very small number, who run their own ideas, and they don't even run investment funds. But suppose you say, well, I do need some infrastructure and scale. The next thing for ideas that are really good, it's natural. What kind of business would you go into? The hedge fund business is one where, and this is how it started, people who, if they need to both think they have skill and have skill, and it's a very hotly contested point. I don't want to say that they automatically do, but it sounds like a good business proposition. Hey, if I can take this money, deploy this capital, make a lot of money, I'd like to do it for a cut for part of the proceeds. That seems to make sense. On the other hand, if what you're doing is basically a caretaker function, so we're going to do it on our best efforts. We're going to, we can run billions of dollars. We can have all the supervision. We can have great websites and accounting, and you can do real-time trading off your phone or your watch while you're doing it. But we're not making or losing money based on it. We're not promising you what the results are. We're going to do our best efforts in something that scales to tens of billions of dollars. That business, where there are fees for assets under management, is where those ideas go that are not necessarily the high alpha ideas. So there's a match for that. But I do think that the kind of things that look like extremely good and profitable ideas, that at least seem that way, how they pan out later on is different, there will always be people ready to invest in them looking for that outsized return as well as the low correlation with other ideas. As Roger pointed out, to the extent that everyone's getting correlated anyways, it really gets less interesting. And since it's easy for managers to hedge away that correlation at low cost rather than having it carry on, the investors certainly should be looking for that. But I do think that it's not just a matter of fees. I do think that there's a stratification of investment ideas. It may be more hope than reality, but certainly the kind of things that draw investors to high fee funds and draw managers to those is the idea that there's something that's genuinely different, that's not an overall commodity that you can scale up and sell for $9 a trade. I'm not saying that it actually is. That remains to be seen, but that's what people are looking for.
Thank you.
Thank you very much. I don't know, we have time for maybe one more question? one more quick question. Nico just looked at his watch. Okay. Okay. Okay, Kevin.
Familiar with this, but there's a website called Kickstart, which allows various people to invest in different projects. It offers the closest thing we have to retail VC product. So there's public has access to VC products. Then Carlyle recently went public, so there is access to just public access, exposure to private equity investments. Do you see any inclination of the hedge fund industry having opening up to the public anytime soon, or to the retail investor?
I can answer, but I'm not an expert on the subject. I know there are some funds that are trying to be set up now that offer usually a little bit more of a limited version of a hedge fund, not that levered and smaller accounts. There's a lot of regulation related to it, so I have to turn it over to somebody else who could really answer it.
Actually, the paper I did with Nikki is called Hedge Funds for Retail Investors. Actually, we used to call it poor man's hedge funds. And this is, so that was, I mean, when we did the paper in 2004, our data ended in 2004, there were only 50 odd funds. And now Paul and I were talking about it earlier today, and you know, he was mentioning now it's 4 billion, you said, how much money has gone into these funds. I mean, it's grown a lot since 2004. There are 300, 400 funds which are doing this in the mutual fund space, but you still have restrictions. You cannot short more than 30%. So there is limit on the margin trading. There is limit. You still have to provide continuous liquidity to your investors. So because you're a mutual fund, so you cannot say I can have lockups and I can have all those gates. You can't do all that. So there is some cost that you bear if you go through these funds, which are operating in the mutual fund space. Even well-known names like AQR, for example, Cliff Asner's firm, they are offering the mutual fund product, which is simply replicating what they're doing on hedge fund side. But the performance is not going to be the same. So you can actually check that out.
I read that a good moderator doesn't talk very much, so I'm going to pass it on to Paul. Yeah, so I mean, my work with Vikas, it's interesting, and both of you do some work in the mutual fund space as well, right? Roger, you sub-advise to American Beacon, is that right?
We sub-advise mutual funds, yes.
Yeah, and then you have obviously a mutual fund of hedge funds, so that's interesting as well. And I don't think you made our sample since we ended in 2004. I think that's when you started, right? So 2005, okay. So I mean, it is an interesting space. I mean, I don't think you're going to see this kind of like this crazy like throw some money into a VC fund, but within the mutual fund space, I think you do see this. And I mean, we thought it was kind of very interesting that, you know, like Vika said, you wake up and suddenly you don't know how to short sell. So for the managers or the fund families that were trying to offer these products and didn't think very hard about how they should do it and just hired their long only guy, they were terrible. So, you know, there's something to be said for the skill in the hedge fund space, and it does translate to mutual funds. The restrictions are there, and you might not want to disclose your positions quarterly, so that's certainly a potential issue. But, you know, there are plenty of funds, I think, that can scale down their leverage. Leverage has been going down anyway. Scale down their shorting to the extent that they need to, and, you know, operate perfectly well in that space. So.
Yeah, I was going to say two things. One is there are some very large investment managers that own and run a lot of hedge funds that are public. And then in terms of the mutual fund of funds, we're involved in helping start one with another business. And it's not something I'm involved in at all. It started in 2005, and it's been going very well. But the idea was to set up under a mutual fund structure something that looked like a fund of funds. And it only invested in other managers. So it had separately managed accounts with managers who didn't charge performance fees. So we avoided that potential problem where you're paying fees to some managers without getting refunds from the others. And it was very diversified, and some of the managers were small. There's the same thing, we didn't talk about a lot, but we alluded to, I know we're at the end of our time, but in investing in hedge funds, everyone on both sides knows how risky it is. And most investors will not want to put more than a certain percentage of their assets in any one fund, nor will they want to be too big a part of any other fund. You don't want to be 50% of the assets of some manager. You'd like to be a smaller part of that. But that said, these things, and now there are some others, do exist, but they're not. They're not the same thing as hedge funds. There's not the access to the same managers. The trading strategies aren't the same. The fee structure isn't the same. But what you do get is tremendous. It's really not comparable. These are really very separate things. But in addition to all the benefits of SEC registration and supervision and liquidity, this has daily liquidity. In addition, the manager has the sub-managers, the sub-advisors, all run separately managed accounts, which means that the mutual fund portfolio manager can see all the positions, can see all the trades, but he also can aggregate them up and see what the actual risks are. So not at some abstract level. It's not like some hedge fund manager sends a quarterly report and says, we have 10% exposure to, European equity markets. This is detailed position by position, and if two managers happen to be, if he finds out one manager is long Google and the other manager is short Google, and he realizes he's paying people who are basically netting their positions out, he can see that. So that kind of structure is really interesting, and there may be more of it. But that is partly one of the things that serves as being the poor man's hedge fund, and they may turn out to do well.
All right. Well, I want to thank our participants for all their time, and to you for the great questions. And now it's time for lunch. Thanks.